Hello and welcome everyone to my channel, The Quality Investor. When researching new stocks, we usually have certain criteria we like. The stocks that make it through our filters are exciting. The best part of investing is buying a new stock and with it, the optimism. Many times though, what looks like a bright, flowery meadow, dark storm clouds are gathering on the horizon. On today's video, I want to discuss the red flags investors must look out for when researching new stocks. When searching, sometimes we'll see businesses with famous logos trading at very low PEs, or their dividend yield is lurching above 5%. Could it be? How is this famous name trading so low? Well, this is why knowing the red flags means as much as knowing the green flags. In order to achieve high returns, avoiding the losers is just as important, maybe even more important, than identifying quality. A stock can present as a great deal only to sputter and drag along for years, or downright lose our hard-earned cash. These value traps are the painful death by 1,000 cuts. As we do our research, we need to know what red flags are waving right in front of us so we can avoid that loser. So we are going to discuss 4 red flags stocks exhibit as warning to stay away. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. The 4 red flags we will cover today are: number 1, margin contraction. Number 2, rising debt and falling cash. Number 3, high capital investment in an ultra-competitive industry. Number 4, recurrent restructuring. Over time, businesses will go through cycles, and sometimes that business will have a down year. Gross operating and free cash flow margins, the big 3, will depress. In any 1 year or even 2-year span, this is probably not cause for alarm. However, a continued contraction of margins over many consecutive quarters and years, this is a red flag. This culminates in issues such as reduced profitability, vulnerability to broader economic shock, hindrance of growth, and more. If underlying costs for materials and labor, fixed costs such as rent, or other operational costs increase, can the business raise prices to offset these margin busters? Many businesses lack the power in the market and thus fall behind competitively. The contra to this is a new, lower price entrant to the market that forces a legacy business to reduce prices, yet costs remain the same. Other factors such as reduced operational efficiency, changes in the market such as new tech or consumer preferences, or simply poor cost control by management all eat away at margins. Ultimately, the business will have to take corrective action, usually negative, to fix this. Layoffs may occur, which hurt morale, or divisions might be sold off. Cost of capital increases because it will be tougher to secure lending or new investment. All of this stifles reinvestment back into the business, which is the main driver of compounding. We're looking here at an example, Walgreens Boots Alliance, ticker WBA. You can see the margin has just been steady decline for the last 10 years. Operating margin as well, and free cash flow margin. Over here we have SG&A as a percent of gross profit, and it's been pretty flat, but then recently, since 2019, it has shot up to 126.35% of gross profit. Walgreens is now operating at a loss. Here we have another example, Warner Brothers Discovery, ticker WBD. Also, just a steady decline in each of the most important margins, and in 2022, a steep drop-off for all the margins. Rising debt and the subsequent decrease of cash is another bright red flag. It introduces tremendous risk to a business as the probability of the worst outcome, foreclosure, increases as debt increases. Cash is sucked away via interest payments. This not only makes it tougher to pay the other operational costs like payroll, remember, creditors always come first. It reduces flexibility to adapt to market changes. This leads to increased stress, which leads to poor decision making. Creditworthiness dwindles, suppliers become nervous. Rising debt is a downward spiral. Here, we're looking at the example of Seagate Tech Holdings. You can see here since about 2019, their cash, which is in green, has declined steadily while their debt has risen simultaneously. You can also see their debt to equity has creeped up over the last 10 years peaking at 46.77 in 2022, and now they're showing negative equity with a negative debt to equity ratio of negative 4.77. You can also see they've had margin decline for Seagate here. So this is a good example of what the red flag of rising debt and lowering cash looks like. If I was researching Seagate Tech Holdings, I would immediately think that this rising debt and falling cash is a red flag. Here we have another example, Oracle, ticker ORCL. Since 2021, their cash has been in a free fall while their debt has continued to rise. You can also see that their debt to equity creeped across the 1 mark in 2018 and is now sitting at 55.54 to 2023. A less obvious red flag is high capital investment requirements. There are certain industries that require a massive and continual infusion of capital into the business to simply maintain its standing in the industry. This capital is required as upfront cash outlay, and it may take years before the business even breaks even on that outlay. And this is simply to maintain normal operations. With all the cash allocated towards maintenance, it is very difficult to find cash to invest in new growth. The caveat to this is that the industry in which the business operates usually needs to be a highly competitive industry. Industries such as this tend to move towards commoditization over time. This means that consumers have low switching costs to competitors and are very price sensitive. An alternative is easily available and of the same quality. Some examples of such industries are the airlines, utilities, and telecom. The winners here are typically the lowest cost producers. These industries suffer from high regulatory environments, a net good for society, which have high administrative costs for compliance and require huge capital outlays for physical assets. This all amounts to a drag on returns for investors. Here, we're looking at Verizon Communications in the telecom industry. You can see the continual investment of capital expenditures has really hurt Verizon's ability to generate growing free cash flow, and growing free cash flow is the key to investor returns. You can also see CapEx as a percent of net income is consistently above 100% of net income. Let's look at United Airlines and the airlines industry. Again, much the same. High capital expenditures really hurt their ability to generate free cash flow. They also have very high capital expenditures as a percentage of net income. The final red flag is a bit harder to discern from financial statements than any one annual report alone. The business has a long history of recurring organizational restructuring. That's just a fancy way of saying management made poor decisions. Now they need to cut costs and lay off people and spend good money after bad for a new direction. Again, not every project a business undertakes will result in success. However, when a pattern of failure after failure emerges, it's a red flag. This signals poor management, which can kill a business faster than anything else. Aside from the money wasted on a bad project, more cash will be needed to start a new project. Even more, failure after failure erodes trust in management's capability. Smartly run businesses know when to cut losses and, if necessary, the people that made those decisions. But if a CEO has a friendly board, poor decisions can run rampant. Great businesses can slowly deteriorate, and with it, investor returns. A notable example is Bed Bath & Beyond. In October 2019, they announced 60 store closures, upping from a previous 40 store estimate from April 2019. Also in April 2019, they stopped their coupon mailers, a core aspect of their business model. Divestitures started in 2020 with One Kings Lane, Cost Plus World Market, and more. July 2020 saw 200 more store closures, followed by another 37 in January 2022. From there, it was a cascade of terrible news that resulted in filing for bankruptcy in April 2023. By the way, they continually use debt to buy back shares as far back as 2004, which falls under red flag number 2. The astute investor could see these signs early. Another less apparent example is Walgreens. See the video I did January 5th this year about their earnings release. The theme running through each of these red flags is less cash available to the business and to shareholders. That will just hurt the ability of any business to grow, which is the necessary factor for compounding returns. Everything always seems to circle back to, is there enough cash to invest? So just be aware of the dark side of finding quality businesses. Rule number 1 is don't lose money. Before we go, I do want to remind you this is not financial advice. With that, thank you for watching today's video. And what sort of red flags do you look for? Let me know in the comments below. Finally, please hit that like button. And if you found this info helpful, consider subscribing to the channel and joining our community. Thank you and happy investing.